Hi everyone, welcome to Money Leaflet. Today we'll be talking about a PE ratio. What is a PE ratio and how PE works in our investment decisions? A PE ratio is defined as a measure of value when we take the current share price of a company to its earnings per share. It simply means by dividing the current share price of a company and divide by its latest earnings per share. For example, Starbucks price is currently at $72 and its earnings per share is $3. The PE will be 24. The question is, why is PE so commonly used in investing in financial terms? Well, that's because it is often used to determine at first hand whether a stock is selling cheap or expensive before investors decide on whether to own the stocks. Because a lower PE of a stock is perceived to be cheaper than a higher PE. For instance, if the price of Starbucks goes down from $72 to $60, the PE ratio will now be 20. So the lower the price against its earnings per share, the lower the PE will be, provided the earnings per share remains the same. But in reality, PE by itself is not precisely accurate to determine a stock's value, because a more comprehensive evaluation is needed to confirm its true value. As such, PE should only be used as an additional checklist to consider a stock's investment decision. However, today, I would like to share with you how PE can be used for other valuations. Do you know that a PE ratio will be very useful in determining an index market of a respective country, and we as investors use this time an entry or exit a long investment in our core portfolio. For example, the S&P 500 or the Dow Jones or even KLCI index in Malaysia. What does it mean? Check a PE ratio of the index for long investment? Yep, that's right. Now, let me illustrate how it means. Let's say the median PE ratio of the S&P 500 is generally at 15. To know whether this ratio is fairly priced or expensive, we can go to the historical data of the S&P 500 past 20 years more. If we see an example in early 1989, when the PE was below 15 to about 11.92, and the S&P 500 was trading at 303 points. On average, it was lower than the median of 15. And if you choose to start adding position during that time, by 2000, the S&P 500 will have gone up to as high as 1,500 points. You would have made a massive gains of 400%. You will also notice that the PE became 30 after that. This way we know the market may have become a little too expensive and we can start being cautious on a long-term position. However, we take a look at 2009. The PE at that time was 70, but on the chart it was on a downtrend. Why? Isn't it the PE should be lower if the share price has gone down? Well, remember, PE ratio is calculated based on its price against its earnings. In 2009, a lot of companies, especially the banks, reported bad earnings due to the financial crisis. So although prices were mostly down, the PE was very high because many companies in the S&P 500 have lower earnings. So a PE ratio should never be used blindly or in isolation. But again, take a look again 1 year later in 2010. The PE suddenly dropped fast to a low of 15.3 in June. There was an indication that the market has begun its recovery, and the market is fairly priced. Entering at this time will earn you a massive fortune, because for the next 12 years of bull run, the S&P 500 has returned a whopping 400% return in 2019. So in summary, PE ratio can be used as a good indicator to know in general whether a market is fairly valued or expensive to buy. That way, we would have been more confident to either enter or to exit the market. We hope this video can help newbies and individual investors in their investing journey. If you like this video, do subscribe to our channel for more videos to come. Thank you.